Hey guys, what's up? How's it going? My name is Rob and welcome back for another video. In today's video, I'm going to be sharing with you guys one Canadian stock I'm going to be focusing on buying in today's video. Now, one other thing I'm also going to be focusing on in today's video is I'm going to talk about a few things here. So as you guys know, I made a big post on Blossom a couple days ago talking about some issues I've been seeing in social media and just some of the people posting on there in general. There's a lot of people posting things like posts to get like fear and to freak people out and confuse people. And I think right now with the way the market's going and that we're dipping and we've seen like about a year or so of some negative returns, so to speak, I think this is like one of the worst things to do. Like, we don't want to instill fear with people right now. We don't want to confuse people. And there's a lot of people kind of doing a lot of preaching and showing things like, oh, like their way is the best way, and making fun of people, calling people's names, calling them stupid just because of their opinions or their beliefs, and just straight up spreading misinformation and just doing some harm to people. So in today's video, I'm going to kind of talk about that as we go through the video, and I also want to really talk about a simple approach that I imply, which is dollar cost averaging, and how dollar cost averaging into a stock can really benefit you in the long term. And I do warn you guys, throughout this video, I do ramble quite a bit, and it is a bit of a long video, so I do apologize, but I really wanted to get some points across, and I really wanted to show you guys how important I think this is to understand. So anyways, guys, hope you guys enjoyed the video. If you guys do like it, give it a big thumbs up, and subscribe to the channel if you guys want to see more videos. Let's jump inside the portfolio. I'll give you guys a quick little portfolio update, and then I'll show you guys what stocks I bought today. Hey guys, what's up? How's it going? Robin here. Welcome back for the quick little portfolio update here. We'll go over the portfolio update really quickly so you guys can see how portfolio is performing, and then I'll talk about the stock I'm going to be looking to buy in today's video. So the first thing I'm going to cover here really quickly is going to be the portfolio value. So we have our portfolio here on Wealth Simple Trade. I'm just going to cover the Wealth Simple Trade accounts today really quickly, just so we kind of get through this on the quicker side and we can focus on the stock we're going to talk about today. I also want to talk about some different things and kind of talk about my strategy a little bit more so you guys can understand it. So first of all, we have $115,000 inside our portfolio. Today it looks like the markets have dipped quite a bit. Canadian stocks here, VDY is one of the big ETFs I hold. I basically have my ETFs here so I can do a quick little analysis if I ever want to check and see what the markets are doing. So our major ETFs here are VFE and VDY. So VDY is down negative 1.45%. This might be the banks. I'm thinking, banks and financials, However, I did see a lot of just regular Canadian stocks also take quite a bit of a hit as well. But, I think that's mostly what's driving that. And then we see a negative 0.86% from VFE. And again, a lot of bank stuff going on, a lot of different stuff going on with the markets. Every day things change. So, but I just like to kind of basically let you guys know what's going on there. We'll talk about the TFSA really quickly since it's the biggest account here. So you have $101,000 inside the TFSA. The one-day return is now negative 1%. So my TFSA overall is down negative 1%. 1 week return is going to be sitting at about negative 6%. So quite a bit drop in the last week. But I'm going to make some points throughout this video and show you guys why that really doesn't matter. 1 month return is going to be down negative 4%. So over the course of the month, we out on negative 4. 3 month return is plus 1%, oddly enough, right? And as you guys, we're zooming out here. And again, you're going to see this trend throughout this video. As you zoom out things, you'll see that you tend to get positive returns and the short-term negative returns don't really matter as much if you follow a basic strategy of dollar cost averaging into the market. The 1 year return is down negative 6, and then all time the TFSA is up 7%. Personal account is more or less the same. I did make some changes here, and this is mostly Canadian based. So the 1 day return on the personal account is down negative 1, 1 month return is negative 6, and the all-time return is plus 1. So again, even our personal account is up a little bit here. Keep in mind, you might see a big drop here. This is because I did sell a bunch of some holdings to put inside my TFSA. And on that note, guys, as I just talked about, you guys can see all the trades I make inside my portfolio on Blossom Social. Check out the link in the description of this video. You guys can see all my trades in real time, all the different stocks I bought. So the main stock I focus on today is I did buy some VFE, I did buy some HYLD. I kind of just used the extra cash I had to buy these funds. But the big fund I'm going to talk about, and actually stock I bought today, is AQN. We're going to talk about AQN, and I'm going to talk about why I'm dollar cost averaging into AQN and why I think it is a good approach. And I'll show you guys my results and how it did for me so far. Okay, so the stock I'm going to be focusing on buying today is going to be AQN Power Utilities. And if you guys follow my channel, I've been kind of dollar cost averaging, which I'm going to talk about a lot in this video a little bit later on, into this stock over the past, couple years, I guess, or so, give or take. Just little small holdings, and I do hold it in ETFs as well. So Algonquin Power and Utilities is a interesting company. The biggest thing we're going to talk about here is going to be the earnings report, because that got published today. So I figure, whenever I'm not the most advanced guy when it comes to my analysis. I focus on the basics, but one of the big things I do like to take a peek at is earnings, right? You want to see a company that's growing, they're doing well, and the Algonquin basically had some really crappy earnings reports. They had a lot of things happen over the past couple years. Like they had the storms, they had the rising interest rates, some of their acquisitions having some troubles with that. So there's different things going on there that really hurt their earnings. And during 2022, overall the year wasn't too bad, but September they had a really hard time. I mean, this is what really dropped the stock, right? That really would cause the big dip to kind of happen, kind of thing. And we can see here that 2022 was not, 2021 and 2022 was a pretty bad year. 2021 was definitely a bad year, overall. We've seen some pretty big drops. Let's go to December. You can see, I guess, March 22. We don't have December listed here, but we can see March, and March wasn't too bad. June wasn't too bad. September was really bad, but 2022 was a rough year for them overall. Now, the good thing to see here is that they are kind of, I guess, recovering in a way. We see EPS beat by 12.51%. So that means they're kind of getting back on track. Potentially. I mean, obviously, they're not out of the woods yet. There's still a long ways to go. But whenever you see a company growing its earnings, it's always a good sign. Again, there's a long ways to go, and nothing is for sure yet. But, the financials are starting to look a little bit better. I'm not really advanced, so maybe somebody could do a deeper dive to kind of give you guys more perspective on things. But hey, if a company is beating their earnings and their financial, they had a decent financial report and, a surprise 12.51 EPS and a 6.32% revenue. Hey, I mean, green is good, right? That's always a good thing. Now, so the price is probably going to jump up a little bit today. It might not, who knows? But that's something to take a peek at. One other thing you can do is if you go to news, you can take a peek at some of these other sites and look at it. I know Yahoo has some pretty good articles on the different AQN financials and stuff like that. So definitely take a peek at that. Get that if you guys want to dive in deeper into AQN. Take it to stock price today. So obviously the earnings call went out today, so we see a 3.14% increase in the stock. That's kind of expected. I mean, once again, who knows what's going to happen? It could go up more, it could go down, it even can finish at a negative. Who really knows, right? Nobody can predict the markets. But again, seeing good financials and good core principles is always a good thing. Now, I kind of said this before when I first started investing into AQN since it dipped. So if you look at, let's take a peek at the 5-year, let's look at the 1-year return, because this gives us a good broad overview of the last year. We can see the stock down is negative 43%. So that's pretty rough. Now, again, the issue here is that obviously it's a risky stock, and if you hold individual stocks, it's going to be a lot riskier. AQN represents a very small percentage of my portfolio. I think it's 2 or 3% or something. It's very little. So obviously my overall portfolio didn't take a big hit, and I'll show you guys an update on my overall earnings for AQN as we go through this video. But the reality here is as this stock dropped, because I believe in the long-term value of the stock, instead of trying to time the market and try to find out, okay, when is the drop going to bottom out? When are we going to go back up, right? I just dollar costed averaged into the stock on a regular basis. And this is one of the smartest things to do if you want to have a safe, conservative way to invest. Dollar cost averaging into a stock, if it's a good quality stock, is not risky. And dollar cost averaging into an ETF like VFE or any kind of index fund is even less risky. It's not risky at all. Although with individual stocks, obviously there's a little bit more risk there. But what you're really doing is you're buying in at a lower price. So if the stock is ever going to recover, you're immensely going to benefit from it. So let's look at the year-to-date returns of AQN to kind of get a picture here. So if you bought the stock, over the past year, ever since the dip, you're going to be looking at buying it around $10, right? Now, if you bought any point throughout this dip, right, you might buy when it's down. You might have bought here. You might have bought here. You might have bought over here or something like that, whatever. If you're dollar cost averaging, you're probably consistently buying on a regular basis, right? If you look at the year-to-date returns, AQN Power and Utilities is up 17%. So if you're trying to time the market and you're not dollar cost averaging, you're going to miss out on that. And to miss out on 17% of a stock is huge. And this is the problem with trying to time the market. And I hope I get this point out to you guys. And we're going to cover some other things here. We're going to look at the all-time return of AQN. So obviously, I don't have a huge holding of AQN inside my portfolio. It's a very small holding. it's not really big. I'm going to go into my Wealthica information here, and I'll come back to you guys in just a second. Alright, so we're back inside my Wealthica portfolio. So guys, I just didn't want you guys to see my information there. But if we zoom down here to AQN, we can see here that we are actually down all-time negative 28%. And again, I didn't have a huge holding. I had about $3,000, maybe a little bit under that when the stock initially dropped. So obviously, me putting in like 50 bucks here and there, 100 bucks here and there, which is what I did. I just put a little bit of my money here and there, whatever I wanted to play around with, that I was willing to lose, but also something that I wanted to kind of take advantage of and take on a little bit of risk. Obviously, it's going to do a little bit more in my portfolio. If you had like $10,000 of AQN and you're putting 100 bucks in like every other week or 2 weeks or month, it's not going to add as much, but you're still going to be dollar cost averaging in, and that's the whole point here. So my return for AQN is actually negative 28 all time, and I was holding before the drop, and my portfolio was like down negative 40%. But because I dollar cost average in, I'm only now down negative 28%. And if we take the dividend yield, the total return, and we add that in, it's down negative 23%. So 23% is a lot better than being down negative 43%. If you're trying to time the market and you didn't buy at all during this dip, you're probably still down negative 43%. And that's the point I'm trying to make. So what do you do now? You wait till it goes up? It's really tricky, right? Like now you could have, let's say you bought, you waited and the stock goes down, and this could happen. I mean, anything could happen. It could drop to the bottom and then you buy there and it goes up and you look like a genius, right? But again, nobody knows what's going to happen. Dollar cost averaging is a much safer approach to this whole thing. I'm going to show you guys the VFE overall market here, because I think this is going to hammer in the fact how dollar cost averaging really works, and how like on a month by month basis or weekly basis, nobody really knows what's going to go on in the market. So let's take a peek at a few years here. We have VFE. I have the monthly return here for the past little while here, and I will bring up a VFE stock here in Google, because I want to look at the year-to-date returns, right? This is a US market. I want to make a point here, or at least show you guys my perspective here. And again, there's different ways to invest, and I'm not telling you guys how to invest. I'm just showing you guys some different perspectives, and you guys can decide for yourself. But I'm trying to prove to people who say things like dollar cost averaging isn't safe, buying ETFs is not a safe way to invest, or not smart, or saying things like, I'm just trying to prove these are facts that I'm trying to show you guys here. This isn't an opinion, this is facts, and it's up to you guys to decide what's right for you. So here we have the year of 2022. We've seen lots of drops in the market, right? So everybody, it's the same thing in 2020. Like everybody was scared. Like everybody talked so much during, February, March, when everything dropped, right? Everybody was freaking out. Everybody's like, don't buy, everything's going to drop. Come April, things go up 11.55%. So anybody who bought here during this dip, or even in January, even when things were up January, like even if you bought here, or you bought throughout the entire year of 2019, your stocks would be up 11.55%. Sweet. That's pretty cool. And then you get another 3%, and then you get 0%, then you get 4%. And everybody here is just like saying, oh no, don't buy, stocks are going to drop. That fear, right? And everybody who didn't buy missed out on these gains. So again, it's important to understand how this works. Same in 2022, right? We've seen lots of drops, and a lot of people, like I don't know what people thought about it, but a lot of people who understand how the way dollar cost averaging works, when they see red, they're like opportunity. And again, I'm referring to good quality stocks here. This is the reason why I'm picking an ETF, because if you buy the broader market, you dollar cost average into it, it's one of the lowest risk types of investments if you're going to hold your stocks long term, if you want to guarantee a return. As long as you're buying, it could be Canadian market, US market, a all-in-one like VEQT or something, you're gonna do quite well. You think it's, if anybody's gonna do well, it's probably gonna be you. So we can see here, like even in 2022, if anybody told you like don't buy, or there's fear because the stock market is crashing, we're gonna keep going lower and lower, lower. It's like, well, if you bought throughout the entire year, in July when we got an 8% return, you would have benefited from that. Like look at how everything dropped. You would have bought everything on sale, and then when July hit, you got an 8% return. Same can be said towards the end of the year. Now again, some of these negatives kind of cancel out the positives, so keep in mind there. But it's the net finish that kind of matters, but also the dollar cost average. So if things are down 4%, you're buying into that dollar cost average. When things go down 3%, you're buying into that. You're averaging out. And then when things go up, not only does your old portfolio go up, but all the new investments you make and the dividends, the yield is important to mention too. And if you had a higher yield stock, This is why if you go inside my portfolio and we look at a stock like Manulife, for example, high yield stock, right? This is the reason why a stock like this, which is down negative 4% for me, actually has a decent or a much more positive total return, is because the fact that those dividends are going back in during the dip. So if you had a 5% yield, right? Like I think Manulife has a 5% yield. The math on that, I guess, would be like 0.4% gain in dividend per month. That's being added to your return too, right? That's going back in, dripping, buying shares at a lower price. So for me, I just kind of want to hammer this in. And again, if we look at VFE year to date, you know, everybody's talking about the market's dropping. Everybody's talking about things are crashing. It looks bad. Well, really, if you bought, I guess we could go back here and look as well. If you bought in January, you'll still be up like 4%. And year to date, VFE is still up 3%. So we still have to lose 3% or 4% to even be in the negative. But if you didn't buy, you're just dropping. You just keep dropping more and more. So dollar cost averaging is one of the most important concepts to understand if you want to have a nice conservative way to invest and you want to guarantee, like again, we're talking about overall markets, but the same thing with AQN, right? If you want to, you know, if you bought AQN and you're waiting for it to drop and you're trying to time the market and you're trying to pick the optimal moment, if you want to get, not only do you would have to get a plus 40% return right now to just hit zero. So if you even wanted like a 10 or 20% return, you have to get a 60% return. That's a lot harder to do than to just dollar cost average, reinvest into it, and then, you know, over time, you just kind of, you know, you take advantage of the dips, you buy it here, and it goes up and you benefit with it. You know, so I just want to kind of hammer that point here. And AQN, you know, I kind of rambled here a lot in this video, and I know I'm not like the most, like I don't give the most like technical analysis of things, but this is just fundamental approaches. And this is why fundamentals of things can understand. So if you understand the fundamentals of a stock, you know, you see good earnings, you see good potential, you like what they're doing, you know, or even if you just do the ETF approach, you know, like you buy VFE or something like that, you're going to do well. Like again, year-to-date return for VFE is 3%, right? 1 year return is down negative 3%. But again, if you buy the dips, you know, and if you're dollar cost averaging and you believe in the stock, you can buy here, you can buy here, you can buy here, you can buy here, and you should, because you believe in the long-term value of the company. 5-year return for VFE, not even including dividends, is 6.1%. It's probably like, I don't know, 6.65, not 6.1, 61%, sorry. Include dividends, maybe it's like 65, 70. If you reinvest the dividends, maybe it's more than that. But you can see like major returns, so you shouldn't care. Like you could buy at any point in time in the last 5 years to be like, hey, look, you know, you're going to do well either way. And AQN, it's the same thing, right? Like if you believe in the long-term value of the company, you could buy here. You could buy here, 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 and you could buy here. And throughout time, because like you're going to benefit from that growth with the dollar cost average approach. So I'm kind of getting to the point where I'm rambling along too much with this video, but I hope you guys, I gave you some perspective. And we can also see the same with some other stocks, even things like HYLD, right? I'm dollar cost averaging into HYLD, right? Again, I didn't have a super large holding, so, you know, obviously adding a little bit to it makes a big difference. Oh, that's not the right one. I'm going to go inside here and we're going to top in HYLD. It is down maximum of negative 27%. So I didn't have the hugest holding here, but you can bet your sweet ass when things dropped, instead of freaking out and letting the fear take a hold of me, I bought into it. I bought here, 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 and I kept buying here. And now that's how my return for HYLD is only negative 10% for stock appreciation, total return negative 5%. So I only need HYLD to increase just from stock growth to get a gain of 5% to have it hit zero. And then if we include the dividends, which is currently at a 14% yield, that's going to get up there pretty quickly for a positive return. Again, I'm not saying you guys need to buy these stocks or you need to take this, you know, I'm not saying this works with everything. I'm just saying, like, if you believe in a good quality stock and you dollar cost average into it, or a fund or an ETF, you should get a good quality return, because if the market's going to go up, we should see a gain here. Even if it went up 10%, I would instantly gain a 10% gain plus the dividends. And you can see how how it works, right? So hopefully I'm getting this example through to you guys, and hopefully you guys are understanding this. And you know, the big thing about AQN is it risky? For sure. Is it a stock that everybody should buy? No. But I'm taking the risk. I believe in the long-term value of the company, and I'm just dollar cost averaging, and anything could happen. It could dip more. We could lose the gains. Who knows? But regardless of what happens, you can bet I'm going to be buying it. So hopefully you guys enjoyed this video. I thought it needed to be said, and I thought I needed to kind of make this point across. But anyways, let me know what you guys think in the comments. Take care, and I'll see you guys later.